the institutional framework of the payments industry. Sorry, we had to start about half an hour late. I had something else to attend to in the morning. So this will be, now we're kind of moving into the areas which are more connected to the theories that we may have learned before, kind of going into the more complex area. So in the previous lectures, we introduced payment instruments and how the instruments evolved. So there was a sort of a historical take. Now we are slowly progressing into the current status. Of course, we always start with the history just the same way we've always done, because it's, as I always mentioned, it's very important for us to know from where things come, because in case we need to go back or something goes wrong, it's very, very important, especially where the institutional framework is concerned. So a lot of my research, I've focused on legacy systems, and legacy systems are basically old systems, and the banking industry has a lot of old systems, because even in Sri Lanka, because as we discussed last lecture, that we have systems that started in the 80s and 90s. So, and the logics that were used when they were designed, the needs of the market, the sophistication of technology, everything was very different those days. So but the concepts, the principles that they embody are resting on sort of core banking, core monetary policy principles. So we need to always understand where we are coming from, and experiences a lot of the time when systems we are learning digital innovation and digital payments and fintech innovation. So a lot of the times when systems face risks, that is, if there is failure, one common reason of such failure happening is because people don't know why certain software is there, why certain programs are in the software, why programs are written in a particular way, and they are afraid to change them because they don't know if they are inadvertently going and upsetting something of the larger system, or whether they will inadvertently violate a regulation, because the regulations are also written into the software. So understanding sort of the wider institutional framework is very important. And so we'll start today with sort of the overall institutional framework, and then subsequently in subsequent lectures we are going to go into more sort of go into those sections and discuss the details of them, right? So this presentation is very text heavy, and I want you to share your experiences as always, and just engage, because as you go up as managers, directors, later on in life, understanding how the institutional framework is very important, because you will no longer be doing operational work or making operational level decisions. You will be making decisions that affect everyone in the industry. So understanding the interconnectivity and why certain institutions are there is very, very important. So engage with the class, and if you have any questions, please do not hesitate to ask, as always. I'm just going to go back to see what. Right. Can I just call out Sachin? I think, Sachin, you were not there last time. Were you there last time? I can't recall. Okay. Right. Which bank are you from, Sachin? Okay, where are you attached to? Okay, nice. Would you like to turn on your mic so that we can hear you? Is that possible? Is your mic not working, Sachin? Sorry, if you can't, if the others can't see, okay, his mic is not working. So if you can't see the conversation, his mic is not working and he's answering us through text. And what is the reason that you decided to take this course, Sachin? I suppose he'll have to type for a little longer for that one. Okay, right. So it's just out of interest, is it? Or are you involved? Okay. Are you involved in any projects related to payment systems or banking at UNICEF? Okay. What is the project, Sachin? I'm sorry, this is such a sort of one-sided sounding conversation for everyone else. So he's connected to the Ministry of Finance. If y'all can't see what's going on in the screen. Okay, right. So is it sort of related to poverty alleviation? Because I just want to know, because I didn't, as I said, I think you weren't there when we started the lecture last time when we were introducing. Good morning, Daparan.
Good morning.
So we were just talking to Sachin, who is from UNICEF. Because he's not a banker. This is why I always ask, because otherwise I tend to think that everyone is a banker because the majority are. Um, Isivara, where are you from? I think we couldn't ask you as well. Is Isivara there? Or okay, Isivara is maintaining silence. We'll move on. So it's good to know that we have non-bankers as well. So good morning to the others who usually join. As always, please ask your questions. So I will return to the presentation now. Right. So we are here now in the course. We are at our third lecture, which is the institutional framework. And I started it as I initially, when I was designing the syllabus, I thought we will talk about the institutional framework of payments industry in Sri Lanka only. But this lecture, I start with a sort of a general level, and then I come back to the Sri Lanka level, right? So as always, feel free to ask questions, and I have no problem with people muting the microphone. And I suppose Isivara, you can raise your hand. So I don't know whether I see it or not when you raise your hand, but definitely when we come back to when I leave the presentation screen, I will see your if you've raised your hand. And we'll probably take a break. We'll see how it goes. We'll take a break probably um 10 10:30. Yeah, let's see, 10:30. We'll see how it goes. Or yeah, we'll see how it goes. So sorry, the font is very big here. The institutional framework of payments of the industry. um, so when we talk about institutional framework, that is a very, very broad term, and it's a very loaded term, and it really depends on where you're coming from. Like if it's from an academic perspective, the word institutions will have a much wider, deeper meaning. And if we are coming from a practice perspective, the word institutional has a more institute, like entity level meaning. Like when we say institution, we think of institutions. So here also I take the practice approach and not the sort of, I'm not going to go into a deep analysis of what institutions are and how institutionalization happens. When we talk about institutional framework, we are really talking about the institutions. But when we say institutions, it is not just the institutions like the banks or the central bank, right? The institutions also comprise of laws, regulations, right? Because the functions of the institutions depend on these laws and regulations, practices, then the systems, procedures. These all kind of comprise and make up what an institutional framework is, right? So it's not, if someone says what is the institutional framework, don't just say the names of the institutions, right? Because we are talking about a framework here, and a framework generally is a rule based system. So if even IT framework or any framework that we discuss, it's the frame is created through rules or regulations, whichever it is. So because it is a boundary. So in that sense, always remember, when we say institutional framework, it is something a bit more than merely listing out the institutions, right? The entities that are operationalizing the framework, right? Um, so any industry, any practice, any activity can have an institutional framework. That's why there is such a, if you are not familiar with the academic side of institutions, you can just Google it, and it's a highly researched area in economics, and it's also a highly debated area. Um, so and that's because institutionalization can happen in any sphere, right? Um, so when it comes to payments, the institutional framework is very complex. It is, even though a payment more or less is something that happens nowadays especially happens really fast, um, and it's quite simple. We just give our money or we just give our card, and within seconds we'll have a message coming back and the payment itself is over. The institutional framework that enables such a quick payment or such an easy payment or a reliable payment is very complex. So to get to that level of efficiency, we have needed a very complex set of a legal framework and an institutional framework. So that so it's once you start um, going through the payments industry institutional framework, you realize how complex it is. For this lecture and for this course, I am not going to the corners of this complexity. I'm going to stay in the main course, sort of the main path. So the discussion will be based on public-private institutions, who are the main players. Simply because it's not very practical, and I don't think at this level you need to know that level of complexity. But keep in mind that that you can't really say that it's difficult to come up with an institutional framework that is exhaustive, right? Whoever draws institutional frameworks of payment industries, you will find sort of catch-all phrases where you have like other institutions, or very broad term, we should capture a very wide group, because payments at the end of the day, as much as there are a lot of formal payments can also happen informally. We discussed this in our first lecture, how anyone within a local environment can very easily have their own payment system, right? And these happen in the world still. We have now those informal payment systems happening at a wider, sort of more exposed level, like with virtual currencies, right? So these are also falling under the informal system still, because central banks don't recognize them as legal tender, or the central banks don't accept in most of the central bank. I don't know. I think a few are considering accepting them into their into the payments and settlement systems, but the large majority don't. So they are also outside the system. So we don't know how they function and how they are managed, how the liquidity is managed there. So because of that, there aren't exhaustive lists. So just keep this practical reality in mind. So when we talk about institutional framework, when we talk about payment industries, we are talking about the mainstream ones where we see and which comes into the monetary system that we operate within, right? So the interconnectedness of the payment industry, we discussed this last time, the network effects, and how the success of a payment industry comes when more and more people are connected to it, right? So this creates an interconnectedness, the network of the payment industry. And when this interconnectedness, basically, as we discussed in the last lecture also, it extends outside the national boundaries. So when we say the institutional framework, if we just think it's very isolated, then again we are cutting ourselves out from the practical operations of a payment system, right? Of course, if you have a very closed economy, or if you have a very underdeveloped economy, which don't have systems, which is highly cash based, it's very insular, then it might not extend out of national boundaries. But given that we are living in 2021, there are very, very few economies that operate like that, right? Sorry, I'm just going to change PC. So when we talk about payment institutional framework, we're talking about institutions that operate outside the national boundaries. So in this lecture, now, as I said, in the point 2, there is the legal framework, and then there are the institutions, right? So in this lecture, we are going to discuss about the institutions. And in the next lecture, we will discuss the legal framework, right? Are there any questions so far? Any questions? Good morning, Gayan. Gayan, are you the one with are you the one who's a sailor?
Yes, 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 right. Good morning.
Good morning. So we were just, you just joined, I saw.
Yeah. Got
So
late.
we've just in the sort of the introductory steps. Are there any questions so far?
Not really, I'll follow it.
Gayatri, any questions?
Ma'am,
Shantika?
we haven't given the tute, ma'am, today tute.
Oh, really? Let me just, give me a sec. Let me just call Kalinga. Give me a sec. So when I share it on the screen, can you see?
Yes, ma'am.
Okay. So any questions with what I presented so far?
No, ma'am.
Okay, right. Okay, so I'll continue. Right, he will upload it now. Am I heard? Can you hear me?
Yes, ma'am.
Okay, right. I'll continue. So as I said, we are sticking to the mainstream institutions. The typical stakeholders are the central banks, the banks, and then we have non-bank payment service providers. So this is the interesting part of payments. Increasingly we are seeing non-bank payment service providers entering the industry, and in the past two lectures also we discussed this with fintechs coming in, telcos. So we have to, now that's the difference between the banking industry institutional framework and the payments industry, right? So in the payments industry, there the boundaries are there is no boundary of it ending. Right now in the banking industry, banks are those who operate with a license given by the central bank, right? It's pretty straightforward. And when we discuss in the next slide, we'll see that definition changes a bit from country to country, but it's fairly clear as to who is a bank, right? But when it comes to payment service providers, a lot of people can be payment service providers, right? And we find increasingly with the popularization of digital technologies and the internet, a lot of digital companies accumulate wealth very, very fast, right? Alibaba in China is a very good example where they moved into payments um, for purchasing from the website itself, and then using these funds to have payment services as well. So they have Alipay and Tencent, right? Now, age-old example, which is a very much good example for this, is PayPal. Now, PayPal started with eBay, right, to facilitate digital payments on eBay. And PayPal became so successful that it started functioning as a company on its own. So, and PayPal is probably one of the first successful, we discussed this in the previous lectures as well, first successful digital wallet, right? And we know how much it has impacted the world's e-commerce as well. So every day we will have new types of payment service providers joining in. That's why we can't put a strict frame and say these are the stakeholders and these are not the stakeholders. And when these new payment service providers enter, we will find that it is not only the central banks, there will be other regulators as well, right? So in Sri Lanka, so far, the main regulator for payment systems is the central bank. So I have just kept it at central bank. But in other countries, in advanced countries especially, there is a move to have regulators outside the central bank. Like in England, you have the payment a system regulator, and then they also have the Financial Conduct Authority. So they have multiple regulators who will have a purview over the payment service providers. So bear in mind, this is the reason I said no list is exhaustive, right? So this is the reality of it. So if you're operating, all of you are in some way connected to this industry. Remember this: there is no one who can be left out by definition per se, except the core definition of whether they're providing a payment service or they are related in some manner to payment services, right? And then the final main stakeholder is the payment infrastructure providers, right? So these are the groups that provide the technological infrastructure. If you went back before sort of large interbank payment systems like digital systems, I remember I met a gentleman in London who's like an expert in payments and been in the industry for a long time, and he said his first job was when he was 16, and he used to be the one who would collect all the bank's checks and cycle it to the Bank of England. That is also an infrastructure, right? So we need to understand that infrastructure is not just digital infrastructure, right? Because infrastructures, as we know, roads, buildings, all those form infrastructure. So whatever vehicle that enables the transfer of money becomes a infrastructure. And in highly unbanked areas, in Africa or in India, part of the infrastructure is would be the vehicles that transport the money from different mobile money agents, right? So infrastructure providers change in that sense. Again, you will understand why I keep coming back to this. It's not an exhaustive list. Here, when I talk about infrastructure providers, I am going to talk about the digital infrastructure providers, right? Because that is the focus of our course. Of course, I'm sure there are, the money, security, cash transfer companies, right? All of the banks have it. The highly secure lorries that take their money around. So those are also infrastructures, right? They are also facilitating payments. They are moving money around. And then the check collection groups. The reason I keep pointing these things out is it's really important that I have been saying this from the beginning. It's really important that we keep an open mind. Though we are going into a phase of digitalization, we must always remember that there are physical aspects involved here, right? And there are actual people involved here. And when we keep reminding ourselves of that, we remember the basics, right? It's very, very important. As managers, as bankers, as people in policy, it's really important to know why things are done and who and how the nature of stakeholders can change and go beyond what is right in front of our eyes or where most of the budget is allocated, etc. Right? So let's start with the bank, though I put central bank first. I put the banks first because banks came first, right? When was Bank of Ceylon established? Does anyone know? Gayatri, do you know when Bank of Ceylon started?
1949.
Okay, so that's before the central bank.
Yes.
And so the reason I asked that question is because most of the time we will find that banks come first, right? As in any industry, right? So regulators are there to regulate a market or an industry. So first, there must be an industrial market, right? If most of the time, that's the way it happens. Of course, later nowadays, sometimes all of this might happen at once. Or we will first have a regulator, and the regulator will start then licensing banks and creating banks. It all just depends on how that economy is functioning, right? In less in less formal economies, less mature economies, sometimes with the spread of the world economic standard, now we all follow the same monetary standards and, central banking standards globally. So, and when people go abroad, we come back with that knowledge and we implement it in our countries, vice versa. Then someone in a less mature country might go and say, hey, why don't we have this? Let's start with the regulator and let the regulator push things. And we will, even in Sri Lanka, there are certain points where the regulator has created new aspects of the industry or new markets because the market itself has not evolved. And for the economy to move to the next level, the regulator needs to take the initiative. But in most times, regulators generally come a bit after the initial private institutions, right? So that's why I'm starting with the banks, right? So the definition of banks, I just touched on it in the last slide. So universally accepted definition of a bank is a institution that accepts deposits. I think that's the main thing, and then provides credit, right? So that's very, very broadly what a bank is. But if we look, and this fits the definition of banks in Sri Lanka as well. But when we look at other countries, we find that sometimes that definition is stretched more, like in the EU, it extends the license to institutions that grant credit but do not take deposits, right? And they can be granted access to central bank money, right? And now with new payment service providers coming in, this has changed again, and there is a new level of access created for fintechs in many countries. Now, the important thing about banks, especially commercial banks, is the access to central bank money. That is the ability to have central bank accounts. Have you all covered central banking monetary policy in your other courses in this diploma or in the previous ones? Have you had courses on monetary policy, central banking? Yes, no, either is okay. I'm not going to ask you any questions on that.
Yes, yes.
Yes. Okay. So is that a yes for all, or are there are things like central bank money, like new words to anyone? No? Okay. Right, so I will then continue thinking that you all know this, because I have not gone into depth to introduce these terms because this is a postgraduate diploma, so I presume that everyone has an idea. So your central bank account, the access to the central bank account is a privilege that banks have, and in Sri Lanka it is mainly given to licensed commercial banks. Of course, in other countries it differs, right? So each central bank will decide who needs to have access to their funds or who needs to have access to their systems. So going about with the extended definitions of bank in the US, bank is synonymous with depository institutions, including both domestically chartered institutions and branches and agencies of foreign banks, right? The category includes state licensed trust companies that are members of the Fed Reserve, right? Such as depository trust companies, AJAC corporations. I don't know what exactly the AJAC is, but CLS is for remittances, cross-border transactions. And again, this is based on who is allowed to maintain an account. Now, you might know that primary dealers can have RTGS, can have accounts with the central bank and use RTGS, right? So we don't call them banks, we call them primary dealers, but they can access RTGS and they have accounts with the central bank, right? And that is for the settlement purposes. Now, when we discuss settlement mechanisms, we will discuss the role of primary dealers and how they connect into this bigger system. But this section of the course, that is up to payments, I will be discussing only of payments instruments and not of settlement related security settlements and all of that, where primary dealers are concerned. So in Sri Lanka is concerned, so the bank is the simple definition that we have, right? So the role of banks. Now, when we consider institutional framework, we're really talking about roles and what people do, what institutions do, why do they do things. Everyone has a role to play, and when everyone plays those roles, things work out. Sometimes the roles change, sometimes new roles are added, the roles get expanded. Sometimes their roles disappear altogether. And this is the case with any market. You know, it is dynamic when it is in use and in evolution. It will change, right? So banks are especially important to payment systems. The payment systems in the economic in the model that we follow, right? And we and many other countries follow. It is based on central bank money, and even though banks came first, after the central bank comes, they come within the purview of the central bank. And so their importance comes because they hold funds, they hold public funds, and they have settlement accounts with the central bank, right? And depending on the arrangement of each country, banks, generally some version of the banks, in Sri Lanka it's a commercial banks, will have primary settlement accounts with the central bank. That is direct access to central bank money, right? So that really facilitates the smooth functioning of the flow of funds within the economy, right? Otherwise, banks might run out of money. They might not have, as banks, you know this, right? Can you, I'll just put this back to you. Anyone who, let's see, how shall we do this? As anyone working on the liquidity management side in the bank, or has worked in those areas? Making sure there's enough money, you know, when the customers turn up, making sure there's enough money for them to withdraw. Anyone who has experience in that side?
Actually, at branch level, we need to maintain the liquidity, I mean, the cash holding to meet the customer withdrawals, but not at bank level.
Right. So at branch level, how do you do that? How do you calculate that amount?
It's not a calculation. We go by the general, I mean, the sense of the withdrawals take place on certain days, like towards the end of the week, and again beginning of the week we usually get collections. So, but we generally, in particular to my branch, we have a general cash holding up to 100 million, but it hovers around 75 level. The insurance cover is there up to 100. We maintain at that level.
And so this is how you maintain. So it's the same with the central bank. So it's kind of like I suppose I'm trying to draw a practical level of how at the central bank also there is you have the SRR levels, and then how much liquidity the bank has to maintain given their payment obligations that will be coming in with RTGS. When we discuss RTGS, we will discuss how that is managed, how the intraday liquidity is managed for the banks, so that the smooth flow happens. And the reason I asked you this was it's very important that you get this amount right, because when a customer comes to the bank, you can't tell the customer, sorry, we don't have money to give you, because that is what creates a bank run. Have you all ever faced such issues where you think, oh, we're not going to have enough cash to, suddenly there are excessive withdrawals on a particular day for some odd reason, or things like that? Have you all encountered such a situation, and how do you all manage that?
Of course, we often experience those kind of things because sometimes some large withdrawals, we may not in a position to honor if it is not pre-notified. But much as possible, the rest of the branches are advised to inform, particularly the paying branch. What we do is generally, if we get the a large withdrawal, if we don't have, we try to arrange it from a nearby branch. So that is the only option. But most of the cases, anything about 10 million, generally all the branches are requested to inform that particular paying branch to have a pre-arranged cash position. Otherwise, we used to give alternate options like maybe another safe transfer or issue of a pay order. Those options are also we use instead of cash.
Yeah, so thank you for that. So the reason I asked this was because to just highlight this, there is improvisation, right? So, going to, connecting to nearby branch and sort of asking them for them to help you honor your obligations. So there is a lot of day-to-day improvisations going on, and in practical banking, this is what happens. In practical any business, this is what happens. Sometimes if you go to, let's say, any shop, sometimes they don't have change, and they will go run to the shop next door and change the money and come, right? So there are practical improvisations, and some of those practical improvisations have deemed very useful. And what we will see is that sort of logic has been included in the institutional framework and in the rules, in the system rules. Intraday liquidity is something on the similar kind of logic, right? Knowing that there are unanticipated liquidity issues that banks will face, right? So when we say rules and practices and procedures, this is what it is. It's we see with experience that there are ways to solve problems without them being written into laws, right? And those practices can become accepted norms and rules within a framework as we go. right? So banks, being in this business of giving money for a long time, have developed a lot of these very sort of practical solutions. And also, since they are regulated and they operate within a very specified model that is defined by law, the risks, the measures of risk management, the prudential measures are much better. So therefore, they earn that privilege of getting access to central bank accounts. That's another reason, right? And banks, at the end of the day, are licensed by the central bank. So they obviously get the central bank access. And banks also provide, depending on the size of the bank, not all banks will have direct access to the central bank, right? So some banks provide services to other banks and also to non-banks. In Sri Lanka, a lot of our models, right? A lot of our regulatory models, especially in terms of the newer payment products and the systems that are coming to, especially for non-banks, we always have a bank in that business model, right? Because banks, because our risk management, our prudential requirements are met via the banks. So therefore, but in any model, you will see that there is a bank in that model. So every system goes through the banks to ensure that risks are mitigated as much as possible to ensure systemic stability and the safety of public funds, right? As I said, all central banks provide accounts to banks, and the types of course change, right? So as we discussed before, banks have been there for a long time, and their roles have evolved historically. If we look at the earlier banks, they do very simply, accepting deposit and giving credit, and basically facilitating payments, right? But with time, as the banking system became more interconnected and sophisticated, and it was more risk oriented, they have somewhat become agents of the central bank as well. They become, sort of practically speaking, they become the first line of regulatory oversight. Bank managers, let's say KYC regulations, all the capital management, the capital requirement, adequacy requirement regulations, everything is done at bank level, right? So banks have a lot of responsibilities now, much more than what they had before. And before, when I say before, I'm talking even as late as 2008, right? The roles, the work that banks have to do, especially if you take the compliance departments, they have ballooned. Like, they have a lot more work to do. And at branch level, your responsibilities may have expanded a lot, and you're not just, you're not just facilitating customers with their banking business, but you have to make sure that you comply to many regulations as well. Have you seen such a change in your experience, where your role has moved just from being a pure banker to something where you have more compliance work, practical compliance work to look after as well at an operational level?
Yes.
So is that, how do you manage that? Is it easier, or do you all have systems? Has it, how is that?
At compliance level, we have a system to monitor the AML and all those things. At the branch level also, we do alert through the alerts, and they rises the STRs for the suspicious transactions. That's how it works.
Yeah, I think because of there being systems now, it's much easier, and a lot of things get flagged on the system itself, so it's not so manual. And I think increasingly now, KYC regulations have changed, and there is non-face-to-face onboarding. So in a few years, I suppose face-to-face onboarding will reduce as well. We'll see how that goes. Banks, on top of being regulated, they're also the delivery channels of central banks issuing money now. In Sri Lanka, those days, I mean, not so long ago, the public would come to the central bank to get money as well. But now banks do that job as well. So there are a lot of work that has moved to the banking channels, and they have become the front line of the industry. They operate a lot as the front line. And as we discussed, I think we touched on this when we were discussing fintechs, and now that is also changing, and the front line is going further with digital channels. You know, even the bank is becoming a second line, and the front line is changing again. And we see that every time historically, the role of banks have changed with crisis, right? If you take the financial crisis and then earlier crises as well, even internal, like local level crisis, the roles of the bank's role in in compliance and the things that they have to do to reduce systemic risk increases, right? So it's really in the bank's interest to ensure that financial system stability is maintained just as much as it is the central bank's interest, because if something goes wrong, the immediate response is more regulation, and it just keeps increasing. So with this evolution, as of today, right? So this will constantly change. So banks facilitate payments to the public, to other banks, especially if there's a tiered model in the payment systems. In many countries, they jointly own payment infrastructures. For instance, if you take Lanka Clear, it's jointly owned by commercial banks, right, and the central bank. And then they contribute to industry policy, right? Now in Sri Lanka, there is the National Payment Council. Has any of you heard, or have any of you heard of the National Payment Council? No?
No, madam.
Okay, so the National Payment Council is actually a very important thing, right? So I have not written this in this slide, but I will explain it to you. Where shall I include it? In which slide shall I include it in the future? I will have a slide for that so that you all can know what the National Payment. You all can always Google it. So the National Payment Council is the sort of the highest strategic decision-making body for payments in Sri Lanka. It started around the early 2000s, right? And it's chaired by the Deputy Governor of the Central Bank, who is in charge of payments. And the members are commercial, are the financial industry representatives. So banks, we have the Security Exchange Commission, we have CRIB, then there are the telcos. So anyone who is connected to payments from the financial industry side, then the infrastructure providers, Lanka Clear, they are there. So the purpose is to decide on the national payment policy, right? And we meet about 4 to 6 times a year. And so it has been instrumental for bringing in a lot of the modern infrastructures, the modernization programs. In recent times, a lot of the fintech work that the central bank does is through the NPC. So we monitor how the new developments, how things like Just Pay, Lanka QR, everything is discussed there, whether they're going together on board, and the banks come together and discuss their issues in implementation, and then the new projects that need to come together. So the CEOs or the people who head the officers who head payments related activities at the banks come and join this meeting. So it's a very important body that makes a lot of important decisions at national level. So when it comes to contributing to industry policy, this pattern we see in other countries as well, because at the end of the day, banking is a very unique industry, right? So is payments, because it happens through central bank money. So there is a center point, right? It's not ad hoc, let's say like the restaurant business where anyone can source their own ingredients and start a restaurant, right? This is not the way. You need to be connected to the system. You need to be connected to the central bank, and you need to become a part of a network, right? So in that sense, the industry is unique. You can't operate all by yourself. And what the decisions of one entity affects everyone else. So industry cooperation is really, really important. And it is so important that it is actually in the law, right? Industry cooperation is it's written in the Payments and Settlements Act. And we see this in many economies where there are successful payment infrastructures, that there is some mechanism for the industry to have a constant communication. So when it comes to the relationship between banks and central banks in payments, it is not a pure supervisee sort of relationship, but there is a dual role. One is banks are supervised, but also banks contribute back on policy, right? And then enforcing regulations, what we just discussed, and also that's the thing. So you have many conflicting. You have to enforce. You have to also comply, right? And most importantly, ensure the safety and stability, because banks are really the first line of defense. And if the banks fall, then the system can fall, because that's where most of the money is, and that's where the systems are all connected. And all the bank systems are also connected to the central bank in terms of the funds as well, right? So it's very important that the banks ensure the safety and the stability of the financial systems. So now we move to central banks, right? The central bank has a very wide role as well. Just like the bank's role is expanding, the central bank's role is also expanding, right? But here I'm just going to pick three, right? For the sake of being focused to the overall objective of the course. I'm just going to keep it focused here. But there are many other roles that the central bank plays, right? In terms of payments, one of the most important roles that the central bank plays is being the settlement agent, right? Now, can someone tell me what this role of the settlement agent is?
Maybe something similar to the clearing settlement happens. Settling at the end of the day the payments to interbank payments.
Yes, you're correct. So that is that is probably when it comes to payments, the primary factor that comes for central bank is the settlement, because the central bank has all the bank accounts and the central bank money is there, right? And then the central bank also acts as the owner and the operator of payments and settlement systems, right? And then, so it also acts as the regulator and the overseer of payment system. So we can now at this point also see that when it comes to payments, much like the bank, the central bank is also playing a very involved and dual and sometimes conflicting roles, right? So we are regulating, we are overseeing, we are also operating, right? And we are also a service provider. We provide the settlement service. So we have dual roles. So if you come to the payments and settlements department, you'll of the central bank, where I am attached to, you will have RTGS on one side, which is where the settlement happens, and next to it, we are there who regulate and oversee the systems. And then you have several other systems that we own and operate. We don't, sorry, not own and operate, that we operate. We own RTGS, we operate ACU, the Asian Clearing Union for Sri Lanka, and then we have forex payments. That for the countries, forex payments are done there, and then Swift messaging. So it's very diverse, the work that goes on in one location, because given the nature of payments, central banks take this sort of dual, or I don't know, even three. That's tripartite, I don't know what you call it. So providing central bank money for settlement. So central bank money is very important for payment systems, right? To facilitate, the reason being to facilitate the convertibility of the different forms of money, that is the commercial bank money, especially. Central banks support the existence of at least one payment system in their own currency, right? That is widely accessible to banks. So in all countries, there will be a local currency payment system that the central bank facilitates, right? So whatever sentence, so banks will have your commercial bank money, but when you that you create and you put into the deposit accounts, but when we go to the ATM and we draw that money, what comes is the central bank issued money, right? Though when you create the deposit, it's just a money creation that goes through. So the central bank money has remained sort of the key of economic transactions, right? Even though there are many substitutes, we discussed this last time as well. The value of the central bank banknote, the central bank currency has remained, and that acceptability is one reason that this system works, right? So if people stop accepting it for many reasons, like let's say inflation, they say it's no longer it's not worth carrying the rupee around. Then this system fails, right? So the banks, everything, it becomes an issue. And so the widespread use of central bank money as a settlement asset reflects the overall qualities of its safety, availability, efficiency, neutrality, and finality, right? So the finality of the payment is very important, that you know that once you transfer this particular amount of central bank money, that it is final, right? There is no further step to complete the transaction, right? And the failure of the settlement institution can have a critical systemic consequence. And the use of central bank as a settlement institution minimizes the risk of this risk occurring, right? So which means because central bank has its own issues, its own money, and because of the systems in place, having this signal organization reduces these systemic risks, right? Instead of just imagining if the alternate, you know, a good example is in England. So before the Bank of England started issuing its money, the commercial banks were able to issue their own money. So then this causes problems of it being accepted by its final. So if you've been to Scotland, they still can issue their own Scottish money from the Scottish National Bank. I think I can't remember the name of it. Royal Scottish Bank. Royal Bank of Scotland, I think. Yeah, and so the notes are slightly different. So before you cross the border of Scotland and England, it's wiser to change that money because sometimes people in England don't like it. But it's the same pound, it's the same GBP. So these can cause issues, right? So so having this single institution really minimizes that risk. And so in the core principles of the committee for, so this is in the Bank of International Settlements. So there's at an international level, there is the Bank of International Settlements, whose principles that generally central banks follow. There are countries that are members of the Committee for Payments and Settlement Systems, that is CPSS. We are not, but we all generally follow through a wider framework. We follow those principles. In the core principles for systemically important payment systems stated by the CPSS, the settlement asset is systemically important system should be preferably a claim on the central bank, or if other assets are used, they should carry little or no credit or liquidity risk, right? So this is the recommendation for countries. So what they recommend is that use central bank money because the systemic risk is less, right? And you might think, why is she saying this? No, this is obviously already used in the rupee. Why is she saying this? We know this already. I am saying this mainly based on what we discussed in the previous lectures of the ability to have alternative payment systems, right? We are in a free market. This is not a sort of a where payments are concerned. There is no sort of a strict thing like if you don't use this, you go to jail. So in this scenario, it's very, very important to keep these factors in mind, right? And the reason that all this is done is to ensure the smooth flow of the economy, right? Stability is the primary purpose of all this, right? So when people want to go and make a purchase or any transaction, they don't have to think of the value of the money that they're getting, whether the value is going to be different, whether they're going to get that value. You know, if there is uncertainty like that, the economic transactions, the flows in the economy will be inefficient because people will hesitate to use that, right? So to keep those efficiencies, only these factors are all important, right? So banks and all stakeholders in the institutional framework have a responsibility to maintain this value and make sure that efficiency flows. Because, you know, people define payment systems as plumbing. So plumbing is the taps, the pipes in let's say in water systems, right? So now plumbing is not very important to us. It's not important to us as long as when we open the tap and the water comes. But if we open the tap and the water doesn't come, right? And it's not a water cut, then the plumbing becomes very, very important. As long as plumbing runs smoothly, no one will have an issue, right? But if the plumbing breaks down, the whole system can break down. So it's really important that we keep this flow as smooth as possible. It has to, if it's smooth, then there won't be any sort of disruptions or noise, right? If there are too many disruptions and noise, that means we have to be a little concerned to see if there is something in the system that the balance has been upset, right? So again, on providing central bank money, there's a lot to talk about. So regardless of the payment system use, all the settlement happens finally at the central bank, right? So when you look at RTGS, you'll see this, you know, like everything comes down to the central bank settlement RTGS system, right? And so the central banks facilitate this settlement process using their own funds, so that they ensure that central banks obviously have their funds, and they can take that risk to ensure that the smooth functioning of the payment system happens, right? So in real-time gross settlement systems, central banks usually provide intraday liquidity so that when banks have a short, so just like this is why I asked you the question about, what do you do when you run out of money on a customer's request. So in settlement systems, central bank is the bank they run to, right? And instead of being the lender of last resort or anything like that, the central bank has come up with this improvised arrangement of the intraday liquidity. So intraday liquidity is calculated depending on the bank, and it's provided free of charge to banks so that they can honor their gross settlement obligations and make sure that banks aren't short. Neither bank is short of liquidity when it comes to their customer payment obligations. In deferred net settlement, that is the end of day settlement, right? So gross settlement is real time. Each and every single transaction gets settled real time, right? In deferred net settlement, which was what you mentioned earlier, the central bank doesn't fund it because it's not necessarily, once you net it out, by the end of the day, the bank can meet its obligations, or they will, get a overnight loan or something like that. They borrow overnight and settle their obligations, right? Now, from a monetary policy perspective, this is very important, right? Why we give intraday liquidity and not any other form of liquidity like through a borrowing mechanism is because if we do so, it can have an inflationary impact, because at the end of the day, with the intraday liquidity arrangement, that means within the day they have to settle it, right? So there is no central bank money going into the system. Now you all have already learned monetary policy and central banking, so you know that when central bank money leaves the central bank and enters circulation, that it can have an inflationary impact, right? So to avoid that, we have this arrangement of intraday liquidity just for practical smoothing of the process, right? Now, in countries where this liquidity management is very good, like Japan and Switzerland, I suppose these two examples are not surprising, given their country is known for like watchers and very strict following of procedures. So they don't have a intraday liquidity arrangement because their banks have a very good liquidity management system where they don't fall short of liquidity. So that's very, very interesting, and I think that's a goal for us to reach, where banks can operate gross settlement systems without needing intraday liquidity support from the central bank. But many countries have intraday liquidity facilities. So UK, USA, Europe, Malaysia, they all and many other countries have the intraday liquidity arrangement, and it is a very reasonable and practical, and it has proven to be a very useful arrangement that has worked well now. Any questions so far? No? So just some more as the settlement agent. We have the other side of it, the access of banks, right? Which I touched on when we were discussing the banks as well. So the relationship between the central banks and the banks in terms of settlement systems depends on, it's also a business decision, right? So though all banks may have settlement accounts, not all banks are direct participants of the settlement systems, right? Because to do so, you need certain financial commitments, because especially for intraday liquidity, for gross settlement, you need to be able, you can't borrow everything from the central bank. And then you need technological commitments, because these are very secure systems. They are very high speed systems. So you can't just join with a not so sophisticated technological capacity. You need to make those developments. So there's quite a bit of investment. There's fees involved. So some banks might think, hey, it's not good business sense for us to join directly, and for this reason there are tiered memberships, right? And these tiered memberships are there all over the world. And so we have the concept of indirect participants, right? So almost all our savings banks are indirect participants. Then finance companies, they are indirect participants. So they go through a main bank, a big bank, that can support their payment obligation. So the responsibilities of the direct participant, right? The direct participant should make sure that enough liquidity is there for the indirect participant to honor the payment obligations. But within these systems, we will see in different countries, they will have different priorities. So direct participants may, if you're settling, if your payment obligation is through a direct participant, it might be faster. And if you're going through an indirect participant, it might be slower. And internationally, this issue is also there in many countries. You know, the indirect participants are complaining, saying, "Oh, it's slower for us," and whatever. Of course, these are business relationships, right? And remember, these arrangements are not only technologically and business relationships. There's the other side of the systemic risk, because things like financial and technological commitments being there is to ensure the smooth flow. So if you can't meet those obligations, it is better for them to be outside the system than come into the system and create some shortfall or technological risk that will affect the entire system, because the contagion risk, that is because due to the interconnectivity, the contagion risk is very high. So it's very important to have buffers. Therefore, the access to RTGS systems are generally tiered, with like top banks having direct access and the lower tier banks having indirect access. And this is there all over the world. This is mainly a practical arrangement to ensure the system stability. So we go into the next point of central banks as the owner and operator of payment and settlement systems. Now, as you can see, most countries, the central banks, no, this is from the World Global Payment Survey, right? The World Bank Global Payment Survey. The World Bank does this survey, I think it's not annual. I suppose it's about every 5 or 6 years. And they send out a number of questions to all the central banks, and we send back answers. And here they have said that 84 of the 90 of all answers, so 84 central banks are operating, 89 of 91. Most of the central banks are operating their RTGS systems, right? So it's quite common. And the central banks choose to do this because of the reasons that we discussed earlier, because of the central bank money, right? So this is the final aspect of regulating and overseeing payment systems, the role of the central bank. So much of this we will discuss in the next lesson, that is the details of legislation. But here, what I really want to discuss is sort of the more conceptual point of why there is a regulator. Now, I said banks come first and then the central bank, right? Or is it the private firms come first and then the regulator? Why? What is the role of a regulator? Any regulator? Can someone tell me what is the role of any regulator?
To maintain uniformity.
Okay, that is one. What else?
And to be the last resort.
Okay.
In case of a dispute or anything of that nature.
Okay. Any other? Would anyone else also like to contribute? The role of the regulator is quite wide, so you can contribute to the answer.
Be a risk taker.
Be a risk taker. Do regulators look like the risk takers to you? Yes, but I get your point. To sort of cushion the risk. Any others? Now we've been discussing the role of the central bank, the role of the banks, how the roles are expanding. We talked about public funds, safety of public funds. So in that sense, what is the role of a regulator?
Ensure no manipulation among the participants.
Yes, yes. So we are getting closer. We are getting closer to sort of to completing the different roles of a regulator. Anyone else? Would anyone else like to add to those answers? Okay, so when we take payment systems, we call them infrastructures. Now let's go back to some basic public economics, like public goods. Do you all remember public goods? Or public infrastructures, whichever terms that were used. Very, this is like even undergraduate we learn this, or A levels also we learn this. Like roads, bridges. Do you all remember what public goods that we discussed, that we learned, and we continue to learn these things? Can anyone recall? So public goods, so this is basically going back to the concept, right, of why regulations come. This is one of the main reasons. So public goods, you have, so there is non-rivalry, that is when one person is using, the other person can use it. One person using it doesn't mean that the other person cannot use it. You can freely access it, right? So these factors are what makes it a public infrastructure. Now, payment infrastructures are also public infrastructures, right? So they might be owned by, let's say, banks or the card schemes or telcos. Telecommunication is also public infrastructure, but they are accessible by anyone who wants to access that system, right? So just because one person is using an ATM doesn't mean another person in another ATM can't use the ATM function, right? Of course, if there's a line, then yes, and there's one ATM machine for practical purposes until the other person uses it. It's the same, like even on a road, if there's a traffic, then you can't enter the road until the traffic clears. Those are practical, but once the traffic clears, you can access that road, right? So payments is the same. So when I make a theft transaction over the internet, it doesn't matter how many other people are making the theft transaction. I can also make the theft transaction. You can't discriminate my use of the you can't discriminate the use of the system. Now, when it comes to things like, let's say, fees, now one person touched on manipulation and things like that. There are certain set fees, right? And then we will find that fees in many things are now going down as well. Now, what is happening there? Now this goes back to this point of banks came first. Now in markets, we let markets determine themselves because that is the way our economy functions. We follow that the market-based economic model. So markets, if markets clear in a normal way, in a fair way, then you don't need to interfere. But if markets manipulate the situation or misuse the situation, and where people cannot use it properly, where access is denied, right? There can be market failures. Well, let's say they start charging very large amounts for interbank transactions. Now, if we start with thefts started at a much higher fee, right? When at a normal market clearing rate, and then the regulator intervened and has brought it down, right? So those are called market failures, where the market doesn't clear at a point where the public can use it, right? And it is creating an anomaly. It's creating an anomaly. It's creating an imbalance in the system. So regulators come in to avoid such market failures. Now we have regulatory powers in the acts to intervene, right? And determine fees, determine access requirements, system rules, standards, all of that. Now, if everyone doesn't conform to the same system rules, the system will fail, right? So we have the power the central bank has the power to make system rules to ensure that everyone conforms, right? Let's say everyone doesn't have the required security standards, right? Now that's a big risk to the whole system. So therefore, we can bring in the rule saying if you don't have this security requirement, you cannot join, right? So now this is at a payment system level. Now banks, when we come to banks, now they have been regulated much earlier than payment systems began to be regulated, right? Banks hold public funds, right? And that's a lot of money. So there is a lot of room for manipulation, misusing that privilege that they have, right? And also, there is also the situation where due to private entities trying to make the best of their economic gains, that they could overall create systemic risks. Now, a very good example was the financial crisis in 2008. Mortgage bankers, investment bankers were trying to make their portfolios better, their earnings better at a very individual sort of selfish level without thinking of the risks on the system. So they were repackaging very low quality bonds and selling them abroad, right? And what happened was some lucky individuals made a lot of money, but many experienced the adverse effects of those, right? Now that was in Sri Lanka, we did not allow such derivative trading because there was no underlying asset. I remember when this happened around the time when I joined the central bank, and at that time we were discussing this, and we were told, okay, and as young central bankers we were saying, okay, and this is before the financial crisis, like why we don't go into derivatives and all of that, and because we were learning these things, and what the senior central bankers told us was there is no underlying asset, so there is a risk, right? And so where there is a risk, we should always protect the stability of the system. Now, in Europe and the US, they had left those basic principles of banking, right? And as an investment. And they thought that this will work because there is so much going on in the system. The system itself will protect itself. But it didn't, right? Because one block, it was like dominoes. Just one block falling was enough for the whole system to crash. And this is why systemic risk is really, really important to understand and know, and also know our role within them, right? So in that sense, Sri Lanka has not had any systemic risk, touchwood, because the banks and the central bank have been cooperating very well, right? And we have been able to, we take conservative approach because of the nature of our economy. Now, when you take the developed markets, they were taking these risks because the economies, the speed of their economies and the efficiencies of their economies are far greater than ours. So they thought that this will clear out, but it didn't. So that's why with the increased sophistication of payment systems and widespread connectivity of different parts of the economy, the payment systems become very systemically important, right? So this, now in the financial crisis, that's really what happened. It was very sophisticated in those countries, much more sophisticated than ours. Actually, ours is not sophisticated when you compare it with them. And because of that, there was very wide connectivity across continents. So US bonds were sold in Europe, right? So when that connectivity happens, the systemic importance becomes all the more relevant. And that's why it's very, very important to regulate properly. And payment systems transmit public funds. So at the end of the day, in the financial crisis also, what the investment bankers and all of them forgot was these were actual people's homes and, you know, actual people's money, and they were giving loans to people who didn't have repayment capacity, right? And loans, like whose money were they loaning out? They were loaning out people of money of people who had saved with the banking system, right? So there is a big responsibility to take care of funds, because payment systems is really where the funds are flowing, right? Otherwise, they are held at banks. So it's very, very important to make sure that the funds are not lost. So when we give approvals and when we look at new systems, we always see how is the safety of funds ensured, because that is fundamental. Like, even if the system is inefficient, we will prioritize the safety of funds first, because it's the public funds, and they have come and given it to us, right? They have come and deposited in banks. They have let their salaries to come into banks, to finance companies. They are trusting us with their funds. So when they trust us with their funds, it is our duty to ensure that they don't lose the value, right? And every day, this is what all of us are fighting for, to protect the safety of the funds. So therefore, payment systems are regulated to avoid potential market failures and systemic risk. And the other side is to ensure system stability, right? If the system is not stable, right, then people won't want to use it. People won't trust it. and stability really translates at a micro level to very simple things. The idea of something being unstable. The other day, I went to a shop and the POS machine was not working. And there was an alternative way to pay, right? And sorry, this is the QR code. So the QR code has a POS machine and the sticker. So now from the sticker, I can pay. But the shopkeeper doesn't know how to figure out the full transaction through the sticker because she is used to the POS machine. So she wants the QR POS machine also to work. So after teaching her, I realized that she doesn't know now how to confirm that the payment has come because it's not her shop. She's just working there. So she is afraid whether the money will come or not. So I instead said, okay, I will come. She said, oh, the bank didn't teach me properly and all of that. And so I said, okay, I will ask the bank to come and teach you. And so I paid from an alternative method. Unfortunately, I had alternative ways to pay. But so that is a very micro scenario of a system not working and how people will go to an alternative, right? So if they don't trust the system, if it's looking unstable, there is one side is the systemic risk, and even at trust levels, people will not want to come, right? So so we go back to what we were saying of alternative methods. So it will be very, very. So these are fine balances that we have to maintain all the time, right? And so when it comes to regulating, this is the point that I want to discuss with. When it comes to institutional framework, not the laws per se. The laws per se I will discuss next lecture. But why we regulate, right? Because when the day when you think, oh, why is the central bank sending us all these compliance things that we need to do and fill and all of that, it is for that. And these regulations are not only locally made, they are in compliance with international regulations, international principles, because as I said, these are internationally interconnected systems, right? So we all comply to same standards, and that makes the country and economy internationally comparable as well. So we are, this next. Right, this is the role of the CBSL. Let's take a break, and shall we come back at 11? Is that okay?
Okay.
Or we can make it a slightly shorter break and finish a little early, maybe about 12:15. What do you all prefer?
That's fine, no? Well,
Okay, we'll take a 10-minute break then and come back at 10 to 11.
yeah.
Okay. Okay. Sachin, you had answered. Sorry, the reason I don't see it because when I present, it goes to full screen. So, yes, as I said before, I can't see until I go out. Let me see if I just present only my screen, whether I can see you. No, it's still the same. Does anyone know if there's a way where I can present and also see the class on Google Meet? Just. I will hopefully figure it out soon before the next one. Right, I will start the next section so that we can finish. Right. So we discussed the role of the regulator, and I think a good reference to understand the roles of regulators, I was just thinking during the break, are things like the garments industry in Sri Lanka. So so there is no regulator for the garment industry, right? But it works fine. It's functioning really well. They're very successful. They are self-regulated, though. They follow international regulations. They're not because they need to meet the standards of other country of the export destinations. So they follow those standards, right? So they're not regulated unless, of course, they take the GSP preference, the GSP facility. They don't get regulated. They can comply to those standards and gain access to the market. So they are, in that sense, self-regulated. So when industries are fairly well self-regulated, then they need to have a very sort of involved regulator is not necessary, but given the sophistication of the financial industry and the systemic risk, and given the number of people who are involved in the financial industry, there is a risk, and therefore almost all financial services are regulated. So you have the insurance regulator, you have the Securities and Exchange Commission. They're all regulators of the financial industry. Then telcos again are regulated. And then you have industries where you have the regulator as a place where you can take complaints to, like food, right? So generally people can start restaurants without permission as such, to the best of my knowledge. But they have to maintain certain food standards, right, by law. So if they don't, then the public health inspector can come and take action. So there are different levels of regulation like that. So that's just because I want you to understand what the regulator does, because especially because in the because the banking industry is highly regulated, and so is payments. So we will see more and more regulated payment institutions joining non-banks. So when that happens, it's really important to understand why they are getting regulated, as opposed to left to their own activities. So the role of the Central Bank of Sri Lanka in payment systems. We are responsible for providing payment and settlement facilities for the commercial banks and primary dealers, and also the banker to the banks, as most central banks. And as most central banks, we also provide settlement account facilities to these institutions, which are participants of Lanka Settle system, right? And we will discuss Lanka Settle when we, in a few weeks. Then, in contrast, retail payment systems, now this settlement facilities are mainly for large value payment systems, right? for retail payment systems, they become important because of their systemically connectedness, which we discussed in previous lectures, because a lot of people are using, not so much the value, right? So central bank is also responsible for providing facilities for clearance of retail payments, such as checks, the slips, SEFs, and we provide these facilities through Lanka Clear, right? In the next slide, we will discuss Lanka Clear's role during the central bank modernization program. The role of Lanka Clear was created. And in these, now you will see the central bank has issued regulations and specified maximum fees which can be charged from the customer. Now this regulation is one set of regulations are ensuring that they conform to safe practices to ensure the systemic stability, security, having sufficient liquidity, availability, access. And then the other is maximum fees. Now that is one very easy place where we can identify the role of the regulator, right? Where banks may decide to charge excessive fees from customers, especially because these systems require a lot of investment, right? They are expensive, they are not cheap. The banks have incurred a lot of infrastructure investments, expenses to deploy and maintain these systems, right? So from a business perspective, they could try to recover this cost. And also from a demand perspective, right? Given that there aren't many alternatives for these facilities, they could charge a high cost, especially for RTGS, where it is for critical large value payments. So there aren't alternatives. If it's very time sensitive, then you can charge more. But we have the concept of the public good and the public infrastructure, where it must not be so prohibitive that people can't use it, where people will revert to putting the cash into their bag and taking it somewhere, right? So we must always maintain that balance. We must consider the realities where banks need to recover the costs, but we should also not make it so prohibitive that customers will not turn up to pay, because then that defeats the purpose as well, right? We must create a level playing ground so that all customers of all banks can enjoy similar benefits, right? You can't, just because you're at a smaller bank, you shouldn't be discriminated from using the infrastructure. So therefore, maximum fees is regulated by us, but also you will see that we don't directly, the maximum fees regulations come a little later, and it happens gradually, where we will discuss with the banks and see what is the best fee to charge. Now the clearinghouse function for retail payments was outsourced to the Lanka Clear, Now it is jointly owned by the central bank and commercial banks, right? This is a point of market cooperation, a public-private cooperation. Now central bank also has, now our payment institutions have the banks, the non-bank finance companies, and now we have two mobile payment systems, the telcos also, the infrastructure providers, who have come in for the low value retail payments, and we regulate those telcos directly as mobile money operators. So telcos are only regulated from the Payments and Settlements Department, and for the KYC requirements from FIU. Right? Any questions on that? Okay, if there are no questions, I will return. So, okay, I'm going to just quickly trace the institutional infrastructure and from which point it has been coming, right? So with the central bank, we start the clearing house function. Now, clearing house, the Colombo clearing house existed before the central bank, right? Clearing is basically, can someone tell me what clearing is? So we have several bankers here. Can someone tell what clearing is?
Maybe refers to the check-based rather bills of exchange among our clients routing through the clearing house. And that,
which one is that? Clearing, is it the meaning of clearing?
Clearing, yeah.
Right. So that is partially correct. So it's not only limited to checks. So any payments, if we use SEFs or slips, any deferred net settlement, any system where the clearing happens, where the settlement happens later. So clearing is the process where you net it out, right? You process it and you clear it for payments. You check, okay, everyone has the balances, and you create a day in balance or whatever the time that the settlement is supposed to happen, and say, okay, bank A has to pay bank B on a gross basis. Bank A will have to pay bank B 500 rupees, and bank B will have to pay bank A 1,000 rupees. Once it is cleared, bank B just has to pay bank A 500 rupees. So that is clearing, and that is what Lanka Clear does. And before the central bank, there was the Colombo Clearing House. So checks. Those days it was the checks. So the checks would all come into the clearing house, and all the banks would exchange the checks and pay the net obligations, right? Then, so this is in 1950 that central bank takes over the Colombo Clearing House and takes over clearing functions for itself, right? So the banks now come to the central bank. Then another important juncture for the institutional framework is central bank joining the Asian Clearing Union, right? Does anyone know what the Asian Clearing Union is? No? So the Asian Clearing Union is a very interesting setup for trade related payments, right? So for countries within the countries that are members of the ACU, we don't have to settle immediately. We get a credit, like we can pay it after, I think, about a month or two. We can settle the net amount at that time. So this is between central banks. This is an arrangement between central banks. The main clearing central bank is in Iran, And so this is a very useful. India is a member, Bangladesh is a member, if I'm not mistaken, yes. So there are many advantages for the Asian Clearing Union, and that is central bank to central bank. So the commercial banks will send their trade payment obligations to the central bank, and then the central bank will settle it between the other central banks, right? So this is for international payments. Then we see slowly, gradually, the institutional framework, the systems coming into place, right? So in 1986, ATMs are introduced. Then in 88, the Sri Lanka automated clearinghouse is introduced, right? So now we've moved to automation, right? From the 80s, we are moving into automation. Then credit cards come into place. Now credit cards start the initial sort of non-cash retail payment infrastructures. In 1994, we joined SWIFT. Can someone tell me what SWIFT is? You must have heard SWIFT codes and all of that. Does anyone, can someone just quickly tell me what SWIFT is? If you know, or how you use SWIFT, or what you use SWIFT codes for in your day-to-day work?
That's again for international trade and settlement.
Yes.
Society for Worldwide Interbank Communication.
Yes. Have you used SWIFT codes in do you use it in your day-to-day work, or have you used them?
Yes, very much. When there's a payment be received from an overseas country, obviously we need to share this bank SWIFT code, and also sometimes the branch code and the bank code, all these information for the sender to remit money to our bank.
Yeah. So basically, SWIFT messages have a standard, right? You have to follow a standard script. You can't write whatever you want, right? So for those who used SWIFT, it's basically a standardized messaging system, and it makes it very efficient. So there are codes, there are ways that you send the message. You can't just write whatever you want. So this standardization enables efficient financial transactions. Then in 1994, we introduced slips, right? But at that point, slips is offline, so it's not an automated system, this system that we have now, right? In 1997, the debit cards come in. 1999, internet banking. Now we discussed this in the previous ones as well. So 2002 is when the modernization program starts, right? Now in 2001, there is the central bank modernization program that begins, and the real institutional framework starts. The institutional framework we see now really starts at that point, right? And then 2002, the Payments and Settlements Department is established. Lanka Clear is formed, and 2002, Lanka Clear starts operations, right? 2003, RTGS goes live, right? And then Lanka Secure, that is for the security settlement. So you can see in quick succession, things are coming into place. And then we have 2005, the Payments and Settlement Systems Act. So the act comes after the modernization, right? So always regulation follows. Not always, but most of the time regulation follows, right? Of course, there are cases where you first have the regulation and then you have where you want to create markets and industries, right? And 2006, the NPC is established. So I stop at 2006 because by this time, most of the core institutions are now created, right? And so there's another point, which is 2004 December, the Red Book. right, of the Bank of International Settlements. Now, the Red Book, those are important. The reason that we state this is because the Bank of International Settlements, you can go to this site and find this book. It gives a very it takes up economies at different times, and it gives a very comprehensive study of the country's payment systems. And of course, the last one was in 2004. So, but we have evolved a lot since then, but the core systems are already there, right? Like RTGS and SLIPS. Now, if you go, a place where all this information is available is the payments bulletin. If you get any payments bulletin, it's there, right? Payment infrastructure providers. Now we are at the last lab, right? So payment infrastructure providers, infrastructure is a very wide concept, right? Much like institutional framework, right? The word infrastructure includes both physical infrastructure and regulatory infrastructure, right? And it is the combination of this that we call together as payment infrastructure, right? So when someone says a payment system, it generally refers to a single system. But when we call it the infrastructure, we're talking about the sort of the wider concept, which includes the laws and the procedures, right? Much like the institutional framework. Here, in this lecture, I will be only talking about the infrastructure providers. And that too, as I said at the beginning, the technological systems, right? So, key payment infrastructure providers in Sri Lanka, we have Lanka Clear, we have SWIFT, there are the card schemes, then banks and non-bank financial institutions are also infrastructure providers. We have mobile operators. Are there anyone that I have missed? Have I missed anyone? Is there any payment infrastructure provider that I have missed in this? Or not included? Can anyone tell me who is not here? Now, we have been studying the different actors and the institutions. Can you tell me a payment infrastructure provider who is not in this list? And who should probably be in this list?
Central bank.
Yes, central bank has not been included, right? So let's add this so that when you're, okay, I'll add it and then you can share. Then I will share again, then Karnika can share it with you. So the central bank is not. Then how does, thank you, Gayatri. How does the central bank become a payment infrastructure provider? Gayatri or anyone?
By providing RTGS and SWIFT facilities.
Right. So RTGS is what we provide. SWIFT is by Lanka Clear. RTGS is the settlement system. So there is no other settlement system provider in Sri Lanka. There are bank level settlements that happen with the bank balances, but they are not centralized settlement systems. So the only centralized settlement system in Sri Lanka is the RTGS system, which is owned and operated by the central bank. Right? Very good. Right. So we'll start with Lanka Clear. What do you know about Lanka Clear? Do you all deal with Lanka Clear as Lanka Clear? Does anyone have any interactions with Lanka Clear? No? So, I mean, generally there is, unless you are from the technical side of your bank, I don't think you have, I suppose I don't know at which point in the bank the batch files are sent, or the RTGS link goes to, so not the RTGS, the batch files for slips and CEFs go to Lanka Clear. I'm not sure at which point they go to. From the bank level, whether it's from the IT department or you have a separate unit that does that. Does anyone know from where the batch files go at your banks? No? Okay. So Lanka Clear was, as we saw earlier, was created in, was incorporated in 2002. And it is the national payment network and it functions under the guidance and supervision of the central bank, because it provides an sort of an agency function of the central bank, right? Under the Monetary Law Act, we have the provision to delegate some of our responsibilities, and this is a delegated responsibility that the Lanka Clear performs. And the decision to make it a private institution was in line with the modernization processes that were going around the world at that time, where central banks were letting go of operational activities as much as possible, given the higher frequency of those activities and the risks involved, so the central banks can focus more on their core policy responsibilities and regulatory responsibilities. Central banks slowly now, when they started, they took on clearing responsibilities, and then as the systems became more mature and there were more sort of secure systems to have in place, they delegated the responsibility to privatized entities. And you see this model in most countries, right? The clearing houses are again privatized and or owned by consortiums of banks. And this is the same in Sri Lanka, right? So you will see a pattern, right? So first the clearing, so the market operated independently, then a regulator came in to regulate the aspects that needed to get regulated. And then when it became clear that certain aspects can function outside the regulator's direct purview, the regulator can let go, and with minimum intervention at operational level, right? So the Lanka Clear shareholding is central bank has about 20%, and then we have the state banks, and the private banks has about 53%. So the way this is the sort of the way that it's written into its articles itself, this ownership structure. There are maximum levels of ownership that certain groups can hold. This is to ensure that it remains a private entity and not a state entity, so that that the whole concept was for it to operate independently, so that banks can take the lead and change for required innovation speedily, etc. Right? And Lanka Clear itself also can do a lot of innovation on its own. So it doesn't have the restrictions that the central bank would have, because the central bank has a much wider role to play than only looking at clearing and new payment systems, right? And Lanka Clear is regarded, it's actually quite a successful private-public partnership, and it's working very well. So as we saw earlier, the operations that were carried out by the Sri Lanka Automated Clearing House was transferred to Lanka Clear, right? And this happened as a part of the modernization program. So part of the modernization program, the Payments and Settlements Department was, so really what was meant by modernization program here was, around that time, the general consensus in the central banking community was that now payments has become very important. It's increasingly becoming important because systems are coming into place, automated systems are coming into place, and people were moving out of only using cash, right? People were using these banking systems. So it came to a point where modernization of payment systems were required. Until that time, the existing like checks and cycling to the banks, that sort of system was sufficient. It didn't matter because economies weren't so advanced at that point. But with IT systems coming in and economy is growing, with financial services really growing. Like if you take UK with Thatcher's time, she really liberalized the financial services in the UK. She reduced a lot of the regulations, and that led to really opening up UK's financial system and it growing. And with all those things happening, the importance of payment systems, transferring money from one point to the other became fast and efficiently and safely became very important. So, and the role of central banks also changed, where certain crises were happening and the systemic risks were increasing, monetary policy responsibilities were increasing. So therefore, restructuring of the central banks as they knew before had to be restructured. So one of the restructuring processes was taking away payments and settlements as a standalone, right? So until that time, these payments and settlements related activities were looked after by a broader, like a banking department or something like that. That was much wide, but that had a very wide ambit, right? So any interaction with banks, one large banking department would handle it. But subsequent to the modernization program, these operational level activities were separated, and the supervisory activity was also separated, so that and something called bank supervision was dedicated department for bank supervision was created, right? And also payment services were not only provided by banks, there were other actors entering. So it made sense to have a wider payments and settlements system, because you remember 2000 we had the dot-com bubble, right? And by that time already there were e-commerce sites in the US and all of that. eBay, PayPal is actually 1998. So the non-bank payment services were coming up, right? Actually, the first digital currency like cryptocurrency was also around that period. The central bank community and the banking industry already started to see these patterns. And when we study the Payments and Settlement Systems Act, we will see that even though Sri Lanka didn't have these sort of what we call fintech innovations at that time, the 2005, the Act itself has provisions for all of these, because at that time in Western countries, these things were happening already. So the main purpose of divesting LCPL was to improve the efficiency of the retail processes. And the principal activities of Lanka Clear is to operate domestically routed interbank retail payment systems, right? So check clearing, slips, then the Seacaps project, I will discuss that later. Then Lanka Sign. Now Lanka Sign is the financial sector certificate authority for the electronic signature, right? Now, systems that are operated by LCPL. SITS is the first, and so you remember SLACH, which is Sri Lanka Automated Clearing House. That was clearing checks. So that was the main task that LCPL took over at that time, because there weren't any other systems as such for them to take over. And SITS was upgraded to electronic check presentment in 2006. The Payments and Settlement Systems Act provided for this, and then it was changed, right? Sri Lanka is one of the first countries to have electronic check presentment. And other countries, some countries have come up with that provision very recently. SLIPS was, as I said, established in 1993, and then it was handed over to LCPL because or it was a retail system. And then there is the US dollar check and draft clearing systems. And prior to that, all domestic interbank USD transfers needed to go via an escrow account of a corresponding bank in the US. With the introduction of this facility, it was domestically routed, right? So all domestic routing is what happens through LCPL. Then we have the Seacaps project. Now the Seacaps project is a very, very important project. It's we've completed 4 of the 5 phases, and its brand name is Lanka Pay. Have you all seen the logo Lanka Pay? Have you seen the logo Lanka Pay?
Yes, yes, ma'am.
Yes, where have you seen
it? Yeah, so on ATMs.
You mainly see it on ATMs, right? What does that mean? What does it mean when you say Lanka Pay? Do you know what it means?
Yes, that connects the interbanks.
What is the functionality that it gives?
So even on non-home bank withdrawals also can be permitted.
Right. So that is what the Lanka Pay that is the brand name, the sort of the technical behind the scenes name is Common Card and Payment Switch, called Seacaps, right? Which is the name that central banks call it Seacaps. Lanka Clear advertises it as Lanka Pay for the general public, right? So it is it was designated as the national payment switch, right? Because what it does, exactly what how you answered, it creates a common switch that facilitates interbank transactions, right? And this is really, really important for retail payments. Because previously we couldn't do interbank transactions at retail level that easily, right? It had to go through slips or RTGS, right? And now, and also if we wanted to get money from an ATM, we have to go to our own bank, right? So what? So that's why you have common, and you have shared, which is a slightly different. But it is this commonness which is the main factor of this system, right? And Seacaps really took Sri Lanka's retail payments to the next level, because it is what has enabled a lot of innovation, right? So CEFs, the basis of CEFs is what is used for Just Pay and Lanka QR. Then you have the common POS switch, which is now the basis for the national card scheme, and we are looking to use it as the national transit card as well, right? So when you go get on a bus or a train, you can just tap the NCS and you can just use that instead of giving cash. Any of your banks are issuing the JCB enabled national, it's called it also has Lanka Pay on it. Any of your banks are issuing it?
Not at NTB.
Not at NDB, not at NDB.
Yeah, we are issuing, madam, HDFC.
HDFC, yes, HDFC is issuing. BOC, have you started? Do you know?
No, ma'am.
Okay. And what are the other banks that are there today?
In Pan Asia, we don't have.
We don't have, right? HDFC, how is the, do you have any other option? This is the only option you have, right, for the card?
We have our own card also, but we have recently we have joined it HDFC.
Okay, your own card is Visa, Master, or both?
No, it is not Visa card. It's just an ATM card.
Okay, it's just for your own system.
Yeah.
Right. Oh, okay. So this is good because you come to the interoperable system here. Right. So the good things are that all of these are now locally routed. So even ATM, the interbank transactions are locally routed, right? Otherwise, it used to be routed via the Visa and Master systems, right? Then recently launched is Direct Debit in July 2020. Now, these are all actually things that came up from the National Payment Council, and these are being continuously discussed, and the development and the adoption, all these things are discussed at the National Payment Council. The common mobile switch is the one that has not yet been, of the Seacaps, that has not been adopted, and the reason for that is now with CEFs and with the fast-paced digitalization, the mobile switch was basically for like SMS-based payments, but now we are seeing that CEFs and Just Pay and Lanka QR, there's an interest for digital payments, digital mobile payments. So this might or might not happen. So we'll see how it goes. And direct debit, how about direct debit? Any of your banks have the facility available? No? So direct debit is, we have several banks that are already there. I can't recall the banks. The direct debit banks are, direct debit is, okay, does anyone know what direct debit is? Does anyone know what direct debit is? So direct debit is where the customer gives a mandate to the bank with required, that is with the required permissions, to pull the payment from to the mandate to the service provider to pull a payment from directly from the bank account, right? We'll discuss this more when we discuss the systems in detail. So this is very good for things like utility payments, where there's where let's say there's like a set fee that can go.
Actually, at NTB, we give that service through our Amex for automated bill settlement.
Right. Through Amex you're giving it, not through the Lanka Clear direct debit, is it?
No.
Okay. So this direct debit method is actually very popular in some countries, especially in the UK. It's very, very popular for utility bill payments, for charities. In the UK, like charities, especially, you know, where there are sort of monthly payments, not only charities, like gyms, every place, you know, so that they can make sure that regardless of whether customers come or not, that the payment is made, the first thing they do is they ask you to sign the direct debit form. So whether you go or not, the subscription is pulled from your account. But with fintechs coming up, people also have, the younger generation seem in the UK, seem to move away from direct debit a bit because of employment related issues. Direct debit really works if you have a fixed income where you know for sure that X amount comes into your bank every month. But if you don't, and if you're in a job that doesn't have a fixed salary, then it can become problematic. So, but of course, these are all options, right? These are all options, and there are a lot of conveniences in having these, but you don't have to miss bill payments, etc. So this is recently launched. It took a little time, but we got there by last year. So Swift. So I think someone already told us what Swift is. It was founded in 1977. It's a cooperative owned by banks, right? So it's an international cooperative owned by banks. And it is properly a global financial infrastructure because it's used almost in every country. And it enables a level of interoperability because of standardization. So what Swift does is coming up with messaging standards, right? So you can't just, as I said before, you can't just write random messages. It has to fit those formats. And then when it follows those formats, it can easily be processed through the payment systems. It's very useful and powerful. And all the banks come together, all the members come together to determine what are the best messaging standards. These days, it is now converting to ISO 20002. Sorry, 222. And that is the latest ISO standard for financial messaging. So that will standardize all the financial transactions to a new way, which will enable more fintech innovation and all of that as well. Now in Sri Lanka, we use Swift messaging quite a bit. We use the infrastructure quite a bit for our systems. RTGS also uses Swift. So interestingly, some countries like India, I think, don't use Swift for their RTGS systems, because I think this was so the last time I checked. I can double check this one and let you know when we are talking about Swift again in detail, how the system operates, because of security reasons. But I mean, these are two sides of the story, right? So almost all the countries use it, and there hasn't been any issues, major issues as such. But like in all payment infrastructures, they all have their risks. Card schemes. So card schemes are usually the ignored part of infrastructures, and many times you won't see these in lists, but I wanted to make it a point to put card schemes into this list, especially in the last two lectures. We discussed how versatile card schemes have been in transforming themselves to remain relevant, right? So they have the plastic card, but there's a lot going on behind the plastic card that has enabled digitalization and fintech innovations to rely on the card infrastructure facilities. So outside slips, right? So slips was a retail payment infrastructure. Apart from slips, and checks, there were no other retail payment infrastructure for interbank payments, right? And the card infrastructure was what really allowed it. So even though it was MasterCard and Visa that we had, this really enabled interbank payment systems, right? So it still is a very, very powerful infrastructure. It is a very old infrastructure. Actually, saw last time it started around 1960s, and much of that infrastructure is quite old, interestingly. But it functions well, and it has evolved. They set their own rules. There are a lot of rules when you operate in card infrastructures. So Central Bank of Sri Lanka doesn't directly regulate card schemes, right? What we do is we regulate the banks, so we regulate the issuers and the acquirers, not the card schemes. The card schemes on their own have a very like a huge amount of rules and regulations to ensure that the system operates very efficiently. Already it's there. So we felt it was not necessary for us to intervene into that point, but we will regulate the banks, the issuers and the acquirers, banks and finance companies that issue cards. And that is our relationship with the card scheme. So we don't have, in Sri Lanka, we don't have, the central bank doesn't have a direct relationship with the card schemes. It is the banks that have the relationship with the card schemes. Prior to CEFs and CEFs related payment methods like Just Pay and Lanka QR, the country has been pretty much relying on card schemes for electronic payments, right? So it's an important infrastructure, and it has its own, as I said, own rules and regulations that govern the mechanism so that it is efficient and safe. And most of the time, it works pretty well. They have their own sort of dispute resolution mechanism and all of that. I was asking last time also, I don't know whether there is anyone today who has any experience in cards, who has worked with cards. I think someone was in card proposal evaluation or something like that, I think. Merchant evaluation, was it last time? I can't remember who it was.
Yes, we do card
Ceylon, right?
issuer evaluation and even the merchant acquisition. That part we are much involved.
So, can you just tell us something about the card scheme? This is Acela, right?
Yes.
Yes. Can you, because I can't see your names. I'm just guessing from your voices. Can you tell us something about this card? Do you know anything about the card scheme rules that the merchants have to comply with or anything like that?
Yes, in case of merchant acquisition, yes, with my past experience at HNB, I did a lot with, we gave the Master and Visa platform for them to accept cards. And now at NTP, Amex also we give. Sometimes the Master and Visa is given through the global payments. It's arranged, so they can't charge anything from the client for the simple fact that they use a card as a payment method. They have to verify the signature, identify the customer in person. So those kind of advices we give to the merchant when onboarding.
Right. That's good. Can I ask you for a favor, if that's possible? Would you be able to the main reason now basic high level things like non-discrimination between cash and card, those sort of rules I'm aware, but sort of the more operational level of how banks relate with the card schemes, I would also like to know, and I think the others also would like to know, would you be able to make us about a 10-minute 5-10-minute presentation next time, Asila? Nothing fancy, just to share your experience.
So on what grounds, ma'am?
Sorry?
On what grounds do I have to? So this
so
is
you have
merchant acquisition.
Yeah, acquisition, basically how banks connect merchants, and how your acquisition, merchant acquisition, how you evaluate proposals, what kind of matters that you all consider, especially based on the card scheme rules.
Surely.
Yeah, if you can, just about 10 minutes next time.
Yeah. Okay.
Yeah, thanks a lot. That would be great. So finally, mobile operators. So they are the new infrastructures that joined the payment infrastructure with e-money. We discussed quite a bit, I think, last time about how they brought in their existing infrastructures. So they didn't have to sort of create new infrastructures to facilitate the payments because the payments were SMS based. But they did have to create infrastructure to facilitate the agent-based cash collection and cash dispensation. And this is a good example of where existing technologies can be commissioned for other industries, right? Now the internet, of course, is the biggest example for that. You know, initially internet was used for like defense purposes, but now it's widely used for every single industry. But other large industries can use their existing infrastructures for various other purposes. Now telecom being used for payments is one thing, because what factor about the telecom infrastructure is it that enabled it to be used for financial for payment infrastructures? Can someone, there is another similar infrastructure that we just discussed. What factor, what feature or capability of the telecom infrastructure was it that was used for payments? Can anyone even guess? What feature, what capability of the telecom infrastructure enabled it to be used for payments? No? So it's sort of we know it, we all know it, which is its communication capability, right? And messaging capability. Its ability to send messages, like Swift, its ability to send messages. Because at the end of the day, if you look at it, all these payment systems that we're talking about, they are basically messaging systems, right? They're sending messages from one point to the other. There is no actual money being transferred through any of these systems, right? The actual money flows will happen via the central bank account. At the settlement level, we will be moving the monies around. And when someone comes and the actual, all the banks will come and return whatever excess funds back to us. And when they want to take the money, they will come and take it from us, right? But the actual, you don't have banks. I don't think banks move cash from one bank to another, right? So it's just the message that is going everywhere. So because it is just a message, that's why telecom infrastructure can be used. That's why the internet can be used, because these are all messaging platforms, right? All these payment systems are messaging platforms. So that's the crux. So anything that has similar features can get recommissioned for another purpose, right? So this is why it was not so difficult to use dialogue Mobitel platforms infrastructures to provide mobile-based payment services, right? Because it is the message that is going. We now recently they have deployed ATM machines because the agent model sometimes is less efficient. So now people can directly withdraw their money from ATMs. But now, so that means now Dialog has extended its own infrastructure. So it's gone beyond just providing, all this time it was just providing telecom infrastructure. Now it has gone beyond and it's providing ATM machines as well. This is how any industry would evolve. So banks first had counters, then it had ATMs. Now it's going completely digital with thefts and trying to get people to just keep money moving from the interbank space, the digital space, without having to come to the bank to withdraw money because the cost of handling cash is quite high. So it keeps evolving. Then in Sri Lanka, now abroad, mobile money operators, as we discussed in Kenya and all of that, those countries, the mobile operator is the one who gets a license and they themselves handle the full operation, right? Whereas in Sri Lanka, we have a hybrid model. So as I said before, in Sri Lanka, we don't give any licenses or approvals if there is no bank involved, right? So the same applies to mobile money. There is a bank, the custodian account arrangement. So there is a bank also involved in mobile money. So the telecoms are not providing these services all by themselves. The regulations require them to come with a bank, right? And we follow this same model because it's very, from a prudential perspective, it is very good because the banks ensure the safety of the funds and they also ensure that the mobile operators follow the necessary compliance required. So I think that is that. Yes, and there are some references that I included. There are of course some more. I just put these in. You can read them as you like. You will. Most of the presentation are summaries from these references, and there were several others, but these are the ones that I sort of thought that might be useful for you to read if you'd like. They're not compulsory, but if you want more information, they are certainly helpful. But this institutional framework for the exam, I will definitely be questioning you on this because it is very important, and it's really, as senior bankers, it's very important to understand this and why the roles of different institutions and why there's regulation and all of that. So are there any questions? Are there any questions? Right. So if there are no questions, we can stop for today. Asela, so I will look forward to your presentation. I think all of us. Champika has his hand up. Champika, is your hand up on purpose, or is it by mistake?
Yeah, it's by mistake.
Okay, because I have noticed with all these team meetings that most of the time hands are up by mistake. Right, so we look forward to Asela's presentation next time. Nothing, you don't need to do anything fancy, just about 10 minutes is fine. And next time we will be starting on the legislation, and we'll probably have to do about 2 lectures on that because there's quite a bit. Right, thank you so much and have a good week. And I will see you next week. Oh, by the way, just to let you know for your planning purposes, I don't know whether IBSL has already informed you. We won't be having lectures from on the 25th, 2nd and 9th so 25th of April, 2nd and 9th of May, we won't be having lectures. IBSL will inform you about the arrangements for those 3 weeks, but I won't be having lectures on those 3 Sundays, and we will start So we will continue until the 18th. And we will start again from the 16th and finish lectures on the 30th of May. Okay? Right, I just want to let you know in case you want to plan anything. I don't know what IBSL has organized. They'll inform you if they haven't already. Right. Okay, thank you. Have a good week.
Thank you, ma'am.